Welcome to the Main Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, joined today by Jordan Main, president of Main Financial Group, as well as joined by Adam Freund, partner at Main Financial Group. And to our viewers at home, are you thinking about the window of time that you have in 2026 when it comes to tax planning and perhaps Roth conversions? Let's think about this for a little bit. You've heard a little bit about the One Big Beautiful Bill Act. Well, guess what? Now that it's a law, is this the perfect landscape that you need to be utilizing some tax strategies? We're going to talk about that on today's show. And if you're curious about the One Big Beautiful Bill Act and how it applies to your taxes, you are tuning into the right spot. Thank you for being with us. Jordan, how are you today?
Oh, I'm very excited. One of my favorite topics of all time. But how are you, Cynthia? It's good to be back here.
It's so good to be back with both of you. I'm so thrilled to be here. Thank you for having me as your host. And I know you love talking about taxes.
I sleep at night dreams about taxation or about eliminating taxation.
Oh, there you go. I like that better.
Yes, you do. Adam, how are you?
Well, no, I'm fine. Thank you.
Well, good. I'm just so happy to be with both of you. And before we get started, this is so fun. So let's just think about this. If you received an IRS thank you note, a thank you from the IRS, if you will, what do you think it would say? Jordan, thank you. Thank you from the IRS.
Yeah, you go first on this one.
The amount of money that I send the IRS, I would probably say, thank you, send more. When is the next check coming?
Yes.
Something like that.
Yeah.
I don't think it'd be a very genuine, sincere thank you.
I think mine would be thank you so much for filing on time every year.
Oh, that's a good one.
Gosh.
Yeah, never had to do an extension, at least not yet.
How much, do you have a lot of useless data in your brain?
I do.
How fast, what is it they spend per second or per minute? Have you ever seen some of those statistics of how much the government really spends? So the amount of money that we send in, all of us, it's spent within seconds.
You can go to
insane.
You can go to usdebtclock.org, usdebtclock.org, and you'll actually see we're at 38 trillion and then some in terms of debt. But in that, it shows how much the U.S. is spending, how much it's taking in, and it looks like something at Vegas.
That is scary. I don't think anybody wants to see that. It's depressing.
It's very depressing.
What would your thank you note say?
Yeah.
Mine would probably say, dear Cynthia, thank you for setting up your quarterly payments, because with me, with my LLC, the way I have my business structured, it makes my life so much easier, because I was one of those people where I was like, surprise, this is what I owe this year. And then I have a panic attack.
Right.
So they're like, thank you for setting this in quarterly. We're just all happier now.
But that's not it's not easy to do when you have varying revenue to sending quarterly payments, because one year might change from the next, right?
Exactly.
I would like one that says, here's a giant check for you.
Oh, no, that would be a great one.
Hey, we've been asking you for too much. We insist on sending it back.
Oh, that would be great.
Which kind of leads into the One Big Beautiful Bill Act because of what's happened this year, or last year and then this year.
Let's talk about that. So this One Big Beautiful Bill Act, it's now a law. And from a high level, what actually changed from a high level looking down?
Well, I'm tax man.
Yeah, well, there's a lot of detail in it, but let's look at like you said, the high level. Yep. They made the 2017 tax cuts. They extended some of the deductions, but they made the brackets, kind of the lower rates and the bigger girth of the brackets permanent. So, but permanent is a loose word, because the next government that could come in, they could vote to make it not permanent.
Right. Next administration could come in, and Congress and whatever.
Yeah,
so some of the extra deductions that they put in there still have some sun out or phase out times and some income limitations. But for all intents and purposes right now, the actual tax rates and their brackets are permanent. They also threw in a lot of other interesting deductions, and they increased some things. Senior citizens get in extra deductions, which is basically implying that Social Security is tax-free, but that's not exactly true. If you're under a certain income and over a certain age, that deduction will make your Social Security tax-free.
And that's only lasting until 2028, right?
It's 2028.
Yep. So that deduction is not permanent.
Okay.
Okay. You just said something too, legislative risk.
Yes, yes.
So we've always talked about risk in retirement, and while we're talking about the OBBBA, One Big Beautiful Bill Act law, that people need to understand that legislative risk is something that people don't plan for in their retirement. One of the ways you can get rid of legislative risk is actually to convert your IRA dollars into Roth IRA dollars. And we've never talked about that before on this show.
That's not true.
We've
but
never.
I want to go back to so what actually changed for people. So a lot of things that you hear this big media push right now that people are going to be getting more refunds back during tax season as we're in tax filing season. And that is true, but there's a little asterisk there.
Always is.
There always is. So we have the deduction for senior citizens. We have a deduction in there for no tax on tips, so to speak. We have the overtime credit back, if you will. The standard deduction went up even higher.
SALT. Right.
SALT, which is state and local taxes that you pay. So the property tax that you pay, any tax you pay the state of Michigan, that used to be capped at $10,000 on your Schedule A. Now that's $40,000. These are all things for 2025. Also, now your car loan interest you can deduct a portion of. All of the things go into play to make your tax liability lower. Well, the IRS in 25 did not change their withholding schedules.
Okay.
Meaning people for all of 25 were withholding money out of their paychecks at the same rates as 2024.
Before the One Big Beautiful Bill.
Before the One Big Beautiful Bill.
Correct.
So the people are going to be getting, in general, everyone will be getting a lot more money back. But it's not necessarily because they, are getting a free check. It's they were over withheld. Does that make sense, Cynthia?
It does.
Their employers were withholding too much out of their paychecks. Now for 2026, the IRS has adjusted those tables, and it'll be, more in line.
Question: State of Michigan, though, has not changed, so 4.25% is still 4.25%.
Yeah, and the state of Michigan is just a flat tax, so that's pretty easy to figure out. But the One Big Beautiful Bill kept the great low tax brackets, the rate and the threshold or the width of it, but then it added in all these other little things too. So I think it's imperative that everyone looks at their own individual tax situation to say, how does this apply for me? What do I have for deductions? Is my house paid off? Do I have mortgage interest? What about homestead? Do I have a Florida house? Am I a snowbird, as we call it? There are so many variables that come into maximizing your efficiency with your tax return.
Most definitely. So can people just kind of relax about taxes right now?
Sure, absolutely. Take a nap. Go ahead. You don't have anything to worry about. Listen, I'm Uncle Sam.
Oh, boy.
Oh, here we go.
Uncle Sam, we want you to grow that IRA account. Don't convert it to Roth. What are you kidding me? Of course, yes, people should be.
We now have props, Cynthia.
We absolutely have props.
Yeah, no, I answer your question. I think this is the exact opposite time of that. We are in the third lowest tax rate environment in our history. And we are in the best threshold, meaning the top income bracket is now over 760 some, I think it's $768,000.
That's amazing.
And at only 37%. You can actually have $500,000 of income, and with the blended rates on the way up, plus the bigger standard deduction, your effective tax rate will be under 30%.
So your tax bracket is one thing, but your effective tax rate is something else. And it's always, for the most part, lower than the tax bracket. People don't seem to understand that.
And that's why it's so important as we talk about these Roth IRA conversions. And I know in our coming segments, we're going to dive deeper into these Roths. And I think a lot of the show's talking about that. But I think now is the exact opposite of taking it easy on taxes. Now is to take advantage of it. Taxes are on sale. Let's put some strategic planning in place to lower your taxes.
Perfect. Well, Jordan, talk a little bit about the RIPT report, because I want to take our first commercial break. What can people expect when they book that consultation?
Yeah, our RIPT report is our personalized financial plan specifically written for you. And the RIPT, there are 4 different parts. RIPT, risk, income, portfolio, and taxes. The R is the risk. How fast or how slow are you driving your portfolio? Make sure that they're in line. The I is the income. Do you have a written income plan, or is it maybe an income guess, right? The P is the portfolio health. How healthy is your portfolio? What fees are you really paying? What sectors are you investing in? Are you beating the benchmarks, the indexes out there? And then the T is what we talked about here, taxes. What plan have you put in place? Is it a Roth IRA conversion, or some of the other things that we're going to dive into later? So call the number, come in and get a free written financial plan.
Jordan, thank you so much. Adam, thank you so much. To our viewers, book that complimentary consultation. If you're rushing out the door, we've made it even simpler. Just grab your smartphone and click on the QR code at the bottom corner of your screen. Schedule that time so you can have your very own ripped report customized just for you. Remember, this is not one size fits all. It's not something that's handed to you when you walk through the door. It's an individualized, customized plan to suit your needs. We'll be right back momentarily. Stay with us on The Main Money Show, where Wall Street meets Main Street.
I was an accountant by trade out of school, out of Michigan State, and I absolutely hated brokers, financial advisors, whatever they wanted to call themselves. I was a tax accountant, and we would share a mutual client, and this broker would advise our mutual client to buy, sell, and never do any tax strategy, and I was left to clean up the mess. So I went to the client and said, please talk to your broker and tell him to knock this off or begin to do some strategy, and the typical broker response was, I'm not licensed to do that. I can't talk about taxes. So I basically decided to get my investment securities license and all my other licenses out of spite so that we could do all the tax planning as part of the investment strategy for our clients. The value of choice, as we always say, if you go to a big box firm, they're going to have one of 6 portfolios, let's say, and you're going to fit into one of those. The value of working with an independent advisor, especially a fiduciary like we are, is that they have to do what's in your best interest, and they can use any program that's licensed out there in America. So a huge difference. After 20 plus years on this side of the fence, I think our industry does a poor job at explaining to the public the difference of those two. I come from a culture of helping people and educating them, not just telling them what to do. So I think people that truly want to educate make a big difference in this industry.
Welcome back to The Main Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, joined today by Jordan Main, president of Main Financial Group, as well as joined by Adam Freund, partner at Main Financial Group. And we're talking all about the One Big Beautiful Bill Act. What changed, and how can you take advantage of these changes? Is it the best time for you to take tax planning strategies to heart? We think it is. Thank you again for being with us today. So, gentlemen, obviously, when we're talking about all of these things with the One Big Beautiful Bill Act, and we're talking about implementing some really powerful tax strategies, talk a little bit about Roth conversions. Are they still a big topic for 2026 when we're talking about the One Big Beautiful Bill Act? Jordan?
100%.
It is the most, we talk about it multiple times a day, all day long. Roth IRAs are just tremendous. The law changed in 2010 where anyone at any income level, at any age, can move money from pre-tax IRAs and convert them, they use this word conversion, convert them into Roth IRAs, which is a name of an account that will never be taxed again. The delicate part is that is a taxable transaction, a taxable event to go from one to the other. So how do you do it without screwing up your taxes? We've created a great calculator tool. What do you want to call it, Adam?
Calculator.
It's online and anyone can use it.
It's only $10.
It's not $10.
What? It's not? Oh, it's free.
It's $9.99, and wait, there's more.
That's right, exactly.
So it is the maintaxbill.com, just as it sounds, maintaxbill.com. And you go in there and just plug in some simple pieces of information. Your age, whether you're married or single, because that determines tax brackets, right? Yep. How much you have in pre-tax IRAs or any IRAs. And so you get to select 2 things. Your tax bracket that you think you'll be in and the rate of return that you think these assets will get. And you type in your email and it will send you a report. And the report says, if I do nothing and hold this, the software stops at age 95, Cynthia. So if you live past that, we'll have to make some different adjustments.
Okay.
So the first section says, if you hold it, here are all the taxes that this IRA will pay you, that you will have to pay, right? And then it has another section that says, if you convert to a Roth IRA, here's how much you'll have to pay in taxes. So we had a little fun before we came out today, and we went right on it. And again, anyone go use it, even other advisors out there, feel free.
This is what he calls fun, folks.
Yeah, fun. So I started with a 65-year-old, and we used the easy round number of $1 million.
Perfect.
And we said, let's just assume a 25% effective tax rate, and we used a 5% growth rate on those assets. So for the 65-year-old that had $1 million, if they did nothing and held it till age 95, now in their 70s, they have to start taking dollars out called required minimum distributions, right? And then the software has them reinvesting those dollars they took out into that same 5% growth rate that we talked about. So that's taxable.
Yeah.
And then upon passing, whoever inherits that money, that's taxable income, right? So 3 different types of taxes. That $1 million IRA was going to cost them, it was $960-some thousand of tax.
Yeah.
Wow.
So almost the amount that they started with
Exactly.
is they're going to pay in taxes.
That's terrifying.
Versus the right-hand column was if they converted it now to a Roth. It takes that same tax bracket, which is 25%. Well, 25% of $1 million is what? $250,000 in total tax. Now, if they converted it all in 1 year, they would be higher than 25%. So if they did it over about 3 years, maybe 4 years, they could stick in that 25% tax bracket. So it doesn't change the concept.
Right.
But on the left side, keeping it as it is, Cynthia, $960,000+ owed in tax, or simply moving it to a Roth, $250,000 in tax owed. What is that difference? That's over a $700,000 savings in taxation just by recategorizing some accounts.
But wait, folks, there's more.
See, knew it was coming.
Yes.
So for the younger people, it even gets more attractive.
Yes.
So I took all the same inputs and just made them 10 years younger.
So 55.
So
I can do that
55,
math.
we've got 40 years of that IRA growing at 5%. Would you imagine that the $1 million IRA would cost them, I think it was, again, I'm going based on memory, but it was between $1.5 and $1.6 million of tax over that 40-year window.
So more than what they started with.
For $1 million IRA, almost $1.6 million in tax.
And what would the Roth be?
The same $250,000.
What?
Wow.
So what's that difference? 1.6 and 2, almost $1.3 million in tax savings for the 55-year-old that simply decided to do Roth conversions now. And even the 75-year-old, go the other way.
Right.
Yeah,
It was the tax savings, not with boring you with more numbers.
No.
But the tax saving was near $400,000 for that.
Right.
And even in your 80s, you should consider it.
The Shermanator asked me.
Even if you're not going to use the tax-free Roth income, give the tax-free Roth to your kids.
Right.
Makes sense.
So the whole misnomer on, hey, I'm older, I shouldn't even look at Roth conversions. I say hogwash.
Hogwash.
Okay.
Maintaxbill.com. Use it today. And that's not just a pitch. Use it today. If you have an advisor, use it. Even with the current advisor, use it.
Yes.
I love that. Well, Jordan, I know that you have a very special offer, you and Adam. Talk about what that is. It's time for us to take our next commercial break already. I can't believe it. It's going
Well,
by so
I think 2 things here we've got to talk about. We're going to throw in a copy of my new book too. Well, new, it was October of 2025, but it's called Main Street Millionaire. How real people build real wealth and keep it. Right? So it's about 300 pages. It's a great financial planning tool, about 25 plus years experience in this industry, client stories in layman's terms, right? Take that New York jargon into easy to understand material. Call us, come in for your free written customized financial plan, your RIP report, your risk, your income, your portfolio, and your taxes. Get a copy of our book, take it all home, all on us.
Jordan, thank you so much. Adam, thank you so much. To our viewers at home, that number to call, 844-462-7839, 844-RIPPED-YES. Once again, when you book that complimentary consultation, come into the office. You're going to get a copy of The Main Street Millionaire, Jordan's book, and you don't want to miss this. It's a great read, full of information, easy to understand, and definitely something that you want to grab. Again, 844-462-7839, or we've made it even simpler. We realize you're busy. If you're rushing out the door, you can just grab your smartphone and click on the QR code at the bottom corner of your screen. That is the way to get on the schedule. That's the fast track to get on the schedule at Main Financial Group. We're going to take a very short commercial break. Don't go anywhere. We have so much more when we return.
A recent MarketWatch story followed a 63-year-old who had everything mapped out for an early retirement until the market dropped. Overnight, his confidence was shaken. Years of saving and planning suddenly felt uncertain.
It's a familiar story, especially when headlines are filled with volatility and downturns. But the truth is, retirement doesn't have to hinge on market timing.
With the right plan, you can build a retirement strategy that prepares for uncertainty. It's about balance, growth for the future, protection for now, and a flexible income strategy to help you stay the course.
The markets may fluctuate, but your retirement doesn't have to. A diversified strategy built around your lifestyle and goals can help you retire and stay retired.
Welcome back to the Main Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, joined today by Jordan Main. He's president of Main Financial Group, as well as joined by Adam Freund, partner of Main Financial Group. What we're talking about today is proper tax planning. We're talking about the One Big Beautiful Bill Act, and what should you be doing currently to make sure that your retirement is secure so that you're paying just what you need to pay in taxes and not too much. Thank you for being with us. So, gentlemen, all of this talk, if you will, about a Roth conversion and doing a Roth conversion, but the question that I have, and probably a lot of our viewers, would be, when does a Roth conversion make the most sense? When do you do one?
Well, one of the things that you can do out there is, most of the time IRA accounts are in the market, right? They're invested in the markets that go up and down. Well, when the market goes down, that's actually a very good time to do a Roth conversion. You're not converting as much as you would be if the market was up, right?
Okay.
So if you convert when it's down, get it over into a Roth. What goes down goes.
Oh, you think it comes back up?
Usually
right?
it comes back up. So therefore, you're gaining in the Roth account. So that's a very good time to do that. That takes planning. It takes a company that actually looks at the tax situation. Advanced tax planning. I wish I knew of a company that did that. Oh, that would be us. We do that. Some other companies can't do that. What else?
I think there's arguments, pros and cons. Some people like to do it early in the year, or when the market's down, try to time the market a little bit so they're converting less, as Adam had said.
Yep.
Other people wait till the end of the year so they know their tax for their income for the year. Thank you, sir.
You're welcome.
I know I keep you around for something like Ed McMahon. Isn't there similar? Johnny Carson, Ed McMahon. There's similarities.
I
there.
absolutely love it.
Yeah.
Oh, this is fabulous.
And I think that there isn't one right answer. I think we're going to talk next about some mistakes people make, but there are always opportunities to convert to Roths.
Right.
And I think whether you do pieces at a time, but it's got to be implemented into an overall strategy, right?
And if you're
it's not just a one and done.
No, it's not.
It's got to be a multi-year
And if you're
strategy.
with an advisor that does not talk about this stuff or says, I can't talk about this stuff, you need to get a second opinion. Come to us. We will give that to you.
Yeah, absolutely. Well, you mentioned it, Jordan. Let's talk a little bit about that. The biggest Roth conversion mistakes that you see. What are people doing wrong right now?
Oh, there's all kinds. Some people take too much income in 1 year, right? Versus looking at a laddered approach over a period of years. They just say, oh, I want to go to Roth, and they dump it all in, and then they trigger too much taxation and cause a higher tax on their other income, right? So understanding your tax return is paramount. I think also not taking into consideration the Medicare IRMA situation.
Yes.
If you have too much other income, you're going to pay more in Medicare. You have to plan for that with some of your Roth conversions. The other issue, which I know it's not always easy to do, is a lot of people like to pay the tax due out of that conversion, out of that account. So there's less money going into the Roth. Let's use an easy amount, $1 million you want to convert, and you're going to owe $300,000 or $400,000 in tax. You have it paid right out of that account. So now you only have $600,000 or $700,000 going into that Roth IRA.
Right.
We would rather see all of that IRA be converted to Roth and then pay the tax due out of
Outside
other
of the
savings,
account.
out of after-tax accounts.
Yeah.
So, but a lot of people maybe don't have that extra disposable income or assets to be able to do that. But that is
people that are younger than age, 59 and a half, have to be, we cannot do it with inside.
They have no choice, right? If they make a conversion under 59 and a half, you cannot pay the tax out of those dollars, or you're going to pay a 10% penalty for an early withdrawal.
Just so ridiculous, isn't it?
It is
it's
ridiculous.
just the IRS. We always joke with people when they come in and we say, well, we don't like the IRS. You're not IRS agents, are you? But it's true. I mean, I don't think most people don't like the IRS.
Right.
Oh, wait a minute, this is
And
on
I know
television.
we're getting to the end of our show. We've talked about Ross, but really quickly, there's some other things that you can do. I mean, you really have to model out your bracketing, right?
There you go.
You've got to look at all your deductions. How about the charitable end of it, right? We had a client that had several $million, and he wanted to convert all the dollars into a Roth, except the amount in the IRA that he could give and offset the RMD amount, the required minimum amount. He could then give to charity. So the offset would be zero.
Right.
And there's some limitations based on your income bracket and your asset size. But for his situation, he could take about $100,000 out, and he could donate $100,000 directly out of that IRA to a charity.
Wow.
So if you think RMDs are roughly 4%, maybe a little bit less than that. But if someone has $2 million in an IRA, their RMD is going to be $80,000 or more. Now you're within that $100,000 that you could say, okay, no tax, Mr. Taxman. That money's going right to the church or the school or whatever is the charitable endeavor. So it's not just converting everything to Roth. There's other strategies that go into the comprehensive tax plan.
And for goodness sakes, don't let your kids inherit your IRA. We've got a plan for that too.
Oh, the worst thing you can ever do is give your retirement account to your kids. It's a tax bomb. They pay income tax at their bracket. It may raise the income. They're paying the tax on their current salary.
Yep.
If you don't need some or all of your IRA, reposition that into a tax-free environment. We like to use IRA legacy strategies. You can also do Roth IRAs, all kinds of great stuff from the tax standpoint.
All these things people need to be considering, but honestly, who should be considering it the most right now? We only have about a minute left of the show, but any one category?
Well, I would say certainly people that are entering into retirement should be. We should be looking at that at this point. It's all part of a plan, right? And if you fail to plan, you plan to fail.
Ooh,
right?
or a goal without a wish.
Is just
a goal without a plan. It's just a wish. You screwed me up on that one.
I did.
Yeah.
Sorry about that.
I think at the end of the day, answer your question, Cynthia.
Yeah.
Everyone should be looking at tax planning. The Shermanator, how old is Shermanator?
87 now.
87 doing tax planning, but boy, that 35 to 40-year-old could really impact some things with a solid tax plan.
Most definitely. Well, gentlemen, thank you so much for another amazing episode this week. To our viewers at home, this is your opportunity to get ripped. Call in today, book that complimentary consultation, 844-462-7839, 844-RIPPED-YES. Or we've made it even simpler. Grab your smartphone, click on the QR code at the bottom corner of your screen. Be safe, be happy, be blessed. We'll see you in the office at Main Financial Group. Take care now. See you soon.